3. Welcome, everyone, to another special edition at StoryTrading. We got Jonah Lupton back. Welcome, Jonah.
Hey, how are you, man?
Good. Before we get started, just throw up a couple slides here, and then we'll just have a chat with Jonah. So first, a quick disclaimer. StoryTrading is not an investment advisor. Investing in securities involves significant risk of loss, and that covers our guest presenters as well, unless they state otherwise. Before we get started on today's topic, which is Upstart Holdings, just want to point out you can go to storytrading.com, click on performance, and just want to point out there, you can see our VIP picks from our presenters and past presenters. You also have Jonah Lupton. I'm going to ask you real quick about DermTech. I still like that. That's
oh yeah, I mean, I still love it.
Yeah.
I know when I came on, the timing was kind of bad. I mean, the stock was in the 60s at that point, but yeah, I mean, this is still a stock that I plan to hold for the next 3 to 5 years. They're changing the face of, let's call it, early detection for skin cancer and other skin issues with a couple other products. Right now, they have their PLA product and their PLA Plus product available through dermatologists, and then later this year, they're going to roll out their Luminate product, which we're not sure yet if they're going to go through dermatologist or it'll be more DTC, with a telemedicine component. And that'll be for people that want to sort of get a diagnosis on their skin, how much UV damage they've had, which could be an indication for future problems, including skin cancer. And then next year, we'll get the launch of carcinoma, which is going to be for squamous and basal cell cancer as well. So, I mean, this story is really just getting started. I mean, the stock did get as high as 84 back in February. So I did my Substack write-up on the stock when it was just under 40. It doubled in about a month. I mean, there were some other catalysts in there as well besides my Substack. And then it's retraced all the way back down into the mid 30s. It's at like 36 right now. I actually added to my position this afternoon, right near the close. So, if people are long-term investors and they're looking for a stock that has, pretty massive upside potential over the next 3 to 5 years, I think DermTech is, still deserves some consideration for your portfolio. It's very, it's going to be a volatile stock. They're obviously not profitable yet. They did 6 million revenue last year. They should do 18 to 20 million this year. And then that's when the growth really starts to compound as they get these other two products in the market. So I'm still just as bullish now as I was a couple months ago when I was on the show last.
Yeah. And that's one I don't want to miss because I was around when Exact Sciences was very early in its growth, and I got shaken out over some volatility, and not just volatility, but just like catalyst not happening as quickly as I wanted in terms of insurance coverage. So I don't want to miss it the second time around. If it doesn't work, it doesn't work. But you got your allocation, and
it's a losing position for me right now. My cost basis on DermTech is in the low 40s. So I mean, I'm technically underwater, but if this stock does what I think it can do in a few years, I'm not going to care what, whether I paid 36 or 38 or 40 for the stock.
So that presentation, actually, if you go to, again, StoryTrading, click performance, there's a link here for YouTube, so you can see that YouTube presentation. I also want to point out today, a really significant day for a couple VIP picks. We had Nomura Medical by Aaron Warwick up 135% today, up 60% since he presented it. And another one that was huge was David's Tea. I think it was only up 18% at the end, but it was up 30% earlier by Florian Bushek. So all in all, our VIP picks up 4.5% today. So it was a really stellar day. Aaron, incredible track record. Same with Florian. You can look at their track record here. Aaron's at 200% annualized. Florian also around 200%. Aaron has a new pick that was presented on Sunday night to our VIP members. So we'll release that this weekend, the YouTube, where you can become a VIP member and get access earlier. And Florian Bushek, another great contributor, he has a VIP pick coming this Sunday night. So you want to tune in for that. All right. So with that, what I'm going to do is the reason, just a quick intro, and then I'll turn off the screen share. Upstart Holdings, $98 over here. There are two kind of reasons I invited you to talk about Upstart. One is this move was just incredible after earnings. It tripled or so in 3 days.
3x in 3 days.
3x in 3 days. And this is not a micro cap. It was already a multi-billion-dollar company. And I was like, that's pretty unprecedented. I don't remember last time I saw a multi-billion-dollar company 3x in 3 days. So that caught my attention.
And there wasn't even a big short interest. So it's not like it was even a lot of short covering.
Yeah. And then Jonah, I noticed afterwards that you were saying this is your top position. So I said, you know what, let's get you on here to talk about it. So with that,
It was either my second or third position going into that earnings report. And then, whenever you have a second or third position go up 3x in 3 days, it's typically going to become your biggest position. So I trimmed it back, once this, I think, I didn't do any trimming that first day. The second day I started trimming after it got over about 110. And then like every $10 it went up, I was trimming it along the way, not really knowing how far it could go. It was already kind of unprecedented what it did. And then that third day after hours, it actually got up above 165. I think it hit 168 after hours. And that's when I did my last trim. And then of course, as you saw from the chart, over the next week or so, it pulled back 20-30%. And then the company did a stock offering, of course, then it pulled back a little bit farther from that. So, and then today, this might be a really nice buying opportunity for long-term investors with the stock back under 100. So, I mean, you're looking at a significant pullback from where it was just a few weeks ago after that Q4 report. So,
sure. And if you can just kind of let us know what happened with that report. Why was that warranted? What really happened over there?
So Upstart went public in December, the same week, maybe even the same day as DoorDash and Airbnb. So they kind of got lost in the whole shuffle, the IPO shuffle. No one was paying attention to Upstart. I don't think anybody really knew what the company did. So it was just one of these quiet IPOs that was still successful, but still an unknown company for most investors. And there really wasn't anybody on FinTwit talking about them. I had someone pop into my DMs in December and say, "Hey, have you heard of this company called Upstart?" And I thought, yeah, I mean, I've heard of them, but when they were a private company. Oh, start video. Okay. Yeah, I mean, I heard of Upstart was a private company because I actually knew some of their VCs, but I lost track of the company as well. So I dug into it, and that's when I realized that what they were doing in underwriting using AI in personal loans to start with, and then looking at all these other markets that they could potentially expand to after they've proven out the AI model. So I did my Substack write-up back in late December on Upstart when the stock was still under $40. And in their S1, they were projecting about $360 million for revenues in 2021. But when they reported their Q4 numbers, back in, I think it was mid-March or maybe early April, I can't remember right now, they raised that guidance from $360 million for 2021 up to $500 million for 2021. They also announced an acquisition of a company called Prodigy, which is it's called an auto dealer software interface kind of. And the personal lending market is big, but the auto lending market is way bigger. I think the personal lending market is like 200 billion a year, maybe 250. I have to double check. Auto lending is around 650 billion a year. So the fact, Upstart announced 9 months ago that they would be getting into auto lending. I think they announced their first partner, their bank partner for auto lending in, I think it was September or October. So we all knew that they were going to get into auto lending, but obviously this acquisition of Prodigy is going to help accelerate that process. When I interviewed Dave Gerard, the CEO, he kind of compared it to, when you walk into a Tesla store, they give you an iPad and you can kind of, you get to walk through the whole process on the iPad and customize your car and apply for an auto loan and do everything very seamlessly. And that is what Prodigy software is trying to do for other auto dealers so they can create a similar experience for their customers. And so not only will Upstart have this software to sell to the dealers, they'll obviously be able to plug themselves in there as the, kind of auto lending AI solution. So I thought it was a really, brilliant acquisition. We'll see if it kind of unfolds the way that we want it to. But just to kind of back up, so Upstart was started about 8 years ago, 3 co-founders, Anna and Dave worked together at Google, obviously pretty smart. Google doesn't hire dummies. And then they also found Paul. Paul was a Thiel Fellow. So if anyone knows Peter Thiel, put together this Thiel Fellowship, mostly younger people. I think they might even all have to be like under the age of 20 or 21, some of the brightest people in the world. And he's basically paying them not to go to school, but to come start a company that he can fund. And I don't know exactly how they all got connected, but somehow Paul and Dave and Anna all wound up starting this company together. Originally, it was actually like what they call P2P lending, which is person to person. And they tried that for a couple of years. They just didn't really develop any traction to that business model. So then I think they actually went to their VCs or their investors and said, hey, this is not working. Do you guys want your money back? And the investors were like, no, you're not out of money yet. You got 6 months or 12 months of runway, try something new. And that's when they just started working on this, this AI model for underwriting. Personal loans right now, like I said, that's where they started, 1,000 to 50,000. They had about 12 bank partners as of the end of 2020, although there was some pretty significant client concentration at the top of that. But they have brought on 5 or 6 more bank partners in the first quarter. We've seen these announcements kind of dribble in. Even last week, they announced a new bank called Drummond Bank down in Florida. That's another new bank partner. And most of these bank partners are now doing both the consumer lending and the auto lending. And I believe they'll see more acceleration with these bank partners now that they can do, both forms of lending. I also think at some point in the future, whether it's this year or next year, we're going to see Upstart expand into additional credit markets wherever there is a kind of the individual's credit worthiness is what matters. So, mortgages and other types of home equity loans and lines of credit where it's really, an individual's credit worthiness, that matters. Student loans, credit cards, and small business loans. Because if anyone's ever applied for a small business loan, SBA, I have, it really comes down to the individual's credit score, credit worthiness, et cetera. So what Upstart's doing that's different from the traditional underwriting models, which are based on Fico scores, which is a 30-year-old model, what Upstart has done is develop this new advanced model that uses 1,600 what they call variables or data points on an individual. So if you think about like an Excel spreadsheet or a Google sheet, all of those columns are essentially, all the different variables in someone's life from, where they grew up, where they live now, where they went to school, their grades, occupation, of course, credit history, and lots of other stuff that we don't even know about. So they're looking at 1,600 data points for someone rather than that traditional FICO score. And what that's enabled them to do is provide a faster, cheaper, more accurate solution for their bank partners. So 70% of the loans are completely automated. So there is no human touching, there is no additional documentation required. It is literally someone either going to the Upstart website to apply for a loan or going to one of the bank partners' websites to apply for a loan. And that process is technically powered by Upstart, but the customer doesn't even know it, because everything is kind of white labeled for the bank. So you go to your bank XYZ website, apply for a loan, and boom, within seconds, if you're approved or not. And then you see a bunch of offers that you can choose from. And that all happens within seconds. And like I said, 70% of the time, it's a no touch, no document loan. Everything is done with Upstart's AI model. And even through the dip last year, the drawdown in the economy and the markets and everything else, where people were losing their income, people were losing their jobs, the default rate on Upstart approved loans did not tick up. And that's just one instance, I suppose, of where this model really proved itself out. But even though and Upstart's bank partners have approved over 700,000 loans since Upstart first launched this model, 6 or 7 years ago. So they're over 700,000 loans. They are over, I'm trying to think what other numbers are out there now. So 1,600 variables, 700,000 loans. I believe they say they're up to 15 billion data points, because every time, think about those 700,000 loans, every time someone either makes a payment or misses a payment, it's that data is collected and enables this AI model to become even smarter. I'm not smart enough to figure this stuff out, but I mean, if you think about it, like, if I take out a loan for for $25,000 and, these are all my variables that help the model determine that I was, credit worthy, and I miss a payment, then I assume that model is going back and looking at those variables and trying to figure out, what was wrong, where did they miscalculate something? So, I mean, this stuff is way over my head, but, Dave, Paul, and Anna have all said that they really, when it comes to competing on hiring, they don't compete with any other banks or fintechs because no one else is doing anything this complex. They compete with the Googles, the Ubers, and the other companies that are hiring computer scientists and PhDs to build these complex software programs, models, AI, et cetera. So, when you think about that, it does sound like the company has a pretty significant head start over anybody else that would try to creep into this space, because they have, not only do they have some of the smartest people working on this already, but they have that 8-year head start and these 15 billion data points that they've collected over the last 8 years that has enabled this model to get smarter and smarter. And because it's gotten so smart, these bank partners are able to issue almost twice as many loans. I believe the number is about 175% more loans without increasing the default rate, right? I mean, because all of these banks, that's what really matters to them is, and banks' balance sheets are stronger right now than they've ever been. If you think about all of this stimulus that's gone out, a lot of that stimulus that went into, people's, the households, into our bank accounts is still sitting there. And it's sitting there on a bank's balance sheet in a savings account or checking account. And the way the banks really make money is by lending that money out. They're going to pay you 0% on your savings account or checking account, and they're going to lend that money out at 4, 5, 6, 7% and make the difference. Now, personal loans are fantastic because those are typically unsecured loans, much higher interest rates, anywhere from, on average, I think 10% to 30% for a personal loan. So banks love doing those sorts of loans because the yield is so much higher. The spread between what, their cost of capital and then what they're, charging you as the borrower. So,
Jonah, I got a couple questions for you.
yeah.
So, yeah, maybe you mentioned at the beginning, but I may have missed it. In terms of the business model, how did they get paid, and how would interest rates, let's say, a rising interest rate environment, impact them?
Yeah, so that question has been asked me a couple times in the last few days. It's certainly possible that rising interest rates could impact Upstart, but I think it would be more about impacting the stock price. Because as the 10-year goes up, right, multiples come down. I don't know how it would necessarily impact the actual business, because Upstart is they're not taking any credit risk. They're really, think of them, even though they're a fintech, they're really more of a software company than anything else. They are enabling banks to use their software to underwrite loans. So they're getting fees on those loans. Upstart's not originating any loans themselves. They're not taking any credit risk themselves. They have said that they have underwritten a few loans themselves, but that's to gather data and just make sure that everything is working correctly with the model. So by having some loans on their balance sheet, they're able to, I don't know if it's monitor them more closely or whatnot, but it's minimal. Most of the loans are, being underwritten and serviced by the bank partners. And then in some cases, those loans are being sold off to institutional partners. So if you go to the investor presentation for Upstart, you'll see a lot of the institutional investors that are most likely purchasing some of those loans that are being underwritten by the bank partners. That's pretty traditional in the credit industry. That's where you have the Goldman Sachs and those types of companies buying these loans and packaging them up and either keeping them on their balance sheets or reselling them to someone else. So, but it's really, 98% of Upstart's revenues come from fees from their bank partners.
Mm-hmm.
So,
okay, so as far as they don't have any credit risk, or if these loans default, they're not going to be.
It doesn't
exposed or
impact them
anything?
at all. Nope.
Okay.
Nope. So where there's some interest rate risk, I suppose, is if, and they're not even in the mortgage industry yet. So if mortgage rates went up and home buying slowed down, that wouldn't impact them because they're not in that industry. From the last week that we've gotten reports from General Motors and Ford and Tesla, it seems like the auto industry is on fire right now. A lot of these companies can't even keep cars in inventory. I've heard inventories are down to under 30 days, which is like historically about as low as it's ever been. So, if people went out and stopped buying cars and there was less demand for auto loans, then yes, that would probably pinch their revenues. And then to the same extent, if people needed personal loans, that might pinch them as well. But I'm not smart enough to know if or when that's going to happen just because rates tick up a little bit. I feel like if someone needs a personal loan for $20,000 or $30,000, whether that rate is 15% or 20%, they need the loan, whether it's to, consolidate their credit cards, whether it's to, putting an addition on the house. That money can be used for a million different things. I think the most common uses though are, debt consolidation.
Mm-hmm. Okay, great. So I think I understand the business model. Anything else you want to throw in there before we get to kind of the valuation?
I was just going to say, so valuation, this is one of those companies, let's be honest. Growth companies in general are hard to really put valuations on it because a lot of it depends on just market sentiment and what's in favor at a particular time. Growth stocks were in favor most of last year coming in this year, and now growth stocks are clearly hated regardless of how strong the fundamentals are. And that's why, Upstart is my largest position right now, because even though they're a growth company, they still have very strong fundamentals. They're profitable. They're generating free cash flow. So they're not like a traditional high growth stock that is losing money, burning cash, having to raise capital, and won't be profitable for 2 or 3 years. Upstart is kind of in a different league. Same with Futu. I kind of put the two of them at they're my two largest positions for that reason, because they're both very profitable with very strong margins. So, Upstart guided to 500 million in revenue for this year. I gotta believe that was conservative guidance. If you give, very few CEOs are going to give overly aggressive guidance for the year, when they're giving it in early 2021. So 500 million, let's just say they do 525 million, because I'm assuming they're going to get something from Prodigy by the end of the year, even though it wasn't baked into that number yet. Now, what's a fair multiple to pay? You really can't do PE multiples yet because the company's still growing so fast. But I personally think that, if they came in at 525 million, that would be somewhere between 120 and 125% revenue growth year over year, with 84% gross margins, and I believe contribution margins somewhere between 46 and 50%. So what you want to use the price to sale. If you use price to sales multiple, if you, let's just call it 10 or 20, 20 times sales. So 20 times 500 is 10 billion. Right now the stock enterprise value is down to 7. So, and I would argue that 20 times sales for a company with 84% gross margins and 120 or 125% top line growth, not even including that Prodigy acquisition or any other credit verticals that they could expand into, would be low. So, like when I do my models, I think I would probably put a 25 or even a 30 price to sales multiple on Upstart for the next 12 months. But, that's what the market's trying to figure out right now. Right now, with the stock at 98, like I said, that brings the enterprise value down to about 7 billion. So divide that by 500. So right now the stock's trading at 14 times sales, you know, with 120, 125% top line growth. And they just did that stock offering. So they have cash on the balance sheet now. I think they're back up to about 300 million on the balance sheet.
So you mentioned that's what the market's trying to figure out, right? With it's at 98, there's some choppiness there. So what do you kind of think the other side of the trade is thinking here? The bears or the shorts? What's their thesis as far as
everything? I mean, everything in growth right now is getting hit pretty hard. I mean, I have over 150 stocks on my watch lists, and 90% of them were read today, and I think probably pretty close to that yesterday. So it's not just Upstart that's getting, you know, beat up right now, but I do think that when we finally find a floor, you know, when the selling finally dissipates and the buyers start to come in and look at these growth stocks again, I mean, I think it's the stocks that have those strong fundamentals and the great margins and free cash flow that are gonna bounce the hardest. And that's why I don't mind being overweight Upstart and overweight Futu, and I'll continue adding as they pull back, because I just think that, you know, once this trend reverses, these are the ones that are going to come out of it the fastest. I mean, there's, you know, who knows what the bears are thinking. I mean, you can always make stuff up that, you know, they are concerned that the fundamentals will deteriorate in a rising rate environment, or, you know, competition is out there somewhere, even though I haven't really seen it. You know, there will be some lockups in the near future, you know, because this is a recent IPO from December. If you look at the cap table, you still have a lot of the VC firms that are on the cap table, you know, and most of these VCs are not long-term investors in these companies, because they have to, you know, they need liquidity so they can return that capital to their LPs. So at some point you're going to have, you know, these VCs are going to have to be selling in the open market to, you know, to close out those positions. But, you know, I can't guess when that's going to happen. I mean, when that lockup window opens, I don't think you're going to see a flood of selling, but you'll get some.
Okay, cool. I got you got time for some audience questions?
Yeah.
Got a couple in chat. If you guys have questions, just throw them into the chat. So got one from Eduardo. It looks like, he says, I'd like to hear what you expect for Q1 earnings call on May 11th. Is that right? Is there an earnings call next week?
Yeah, May 11th.
Okay.
Let me just double check. I mean, I haven't even, I'd have to double check what the numbers are going to be. I don't memorize these numbers on all of the stocks that I'm watching. So 2020, so 116 million. I mean, it's like, I rarely get worked up on what the quarterly numbers are going to be. I mean, there are certain stocks in my portfolio that I expect to be long-term positions. Upstart is one, Futu is one, DermTech is one, you know, there's a few others in there as well. I'm not going to overreact to earnings one way or the other. If I have some cash in my account and the stock pulls back after earnings, there's a good chance I add to it. You know, if they blow out numbers and the stock pops 15, 20%, you know, I might even trim some, you know, just kind of portfolio management, risk management, because at that point, the position might just be too uncomfortably large for me. So, I mean, I'm more focused on what they say about the underlying business, the integration of Prodigy. What do they do with guidance? Do they keep guidance at 500 million for the year? Do they raise guidance? You know, what are the gross margins? What are the contribution margins? I mean, if the consensus is 116 million and they come in at 114 or 118, it really doesn't change my long-term thesis on the company. You know, let's just say they do 525 million this year, and then they grow another 70% the year after, 60%, 50%, 40%. I mean, I know those are just random numbers, but I mean, that's how a lot of analysts kind of put together their 4 or 5 year models. But if you use those numbers, right, 125% this year or 120% this year to 525 million, and then 70% revenue growth next year, 60, 50, 40, that takes them to $3 billion in revenue by 2025. And I think that's actually a reasonable target for them. So 3 billion in revenue by 2025, you know, I don't know, 10 times sales, 12 times sales, 15 times sales. I mean, hard to know what the right multiple will be in 4 years, but you know, worst case, let's take 10 times sales. You know, you could be looking at a $30 billion company in 2025.
Okay, great. You mentioned something I want to chat about a little bit. You mentioned you may kind of rebalance your portfolio if there's a move. And we had a really interesting chat today in our VIP community just about that. In fact, you know, we have a lot of influencers in our community, collaborators. They present on Zoom. They write Seeking Alpha articles, and the question came about, you know, if you're reallocating something to maintain a certain percentage, that's not really selling a position, right? In fact, we came up with the word. It's right sizing was a great term that was being used. I'm just right sizing my position. I'm not selling it. I'm still just as bullish as I ever was. And
oh yeah, especially in this market, you know, this
yeah,
is a very volatile, choppy market. With, you know, I mean, think about it. Like every time we get CPI and PPI and housing, I mean, like there's so much data that comes out every month, and then you have to worry about the 10-year Treasury and so many other things. I think, you know, you have to be able to take some profits in this market. You know, thankfully, I did some trimming in my portfolio back in February, even to my favorite stocks. And just because you trim a position by, you know, let's just say you own 1,000 shares and you sell, you know, 100 shares, so you trim your position by 10%, doesn't mean you're any less bullish on the company. But it's just about right sizing your portfolio. And if the stock pulls back 15-20%, maybe that's when you decide to, you know, buy those 100 shares back. So I did a little bit of that in February. Obviously, I wish I'd done more. I wish I'd bought some put options on IWO or IWM. You know, that would have helped me out these past couple months. But I mean, there's stocks in my portfolio that I've been trimming on and off for the last couple months, and it doesn't mean I'm any less bullish on them.
all right, we got a whole bunch of questions. I'm not going to ask them all. I'll select some in here, but we got, are you nervous? RJ says, are you nervous that 67% of the credit apps are all coming from one bank? He says all coming from Cross River Bank.
Yeah, I think it's lower than that now. When that might be an old number.
Yeah, I don't know when it's from.
Yeah,
mention.
I don't think that's the current number. I think that might be from their S1. But I mean, and management's spoken about that. I mean, they've addressed that. They've said that they are trying to diversify, you know, their concentration risk, and that's why they've been bringing on these other banks. I mean, they've brought on at least another 4 or 5 bank partners in the last couple months. Some pretty big ones. Drummond Bank, the one in Florida, was probably the smallest. I think they only have a couple billion in assets, but they brought in a couple other banks. I think one was First Financial or First Trust. Another one was called Apple Bank out of New York. And both of them are 30-40 billion dollar banks. So pretty decent size.
We got a question from Rob Mock. Was a comparison ever done on default rates or missed payment rates of loans using Upstart versus traditional banks using FICO scores?
Yeah, I mean, I think those numbers are either in the S1 or the investor presentation. I don't remember them off the top of my head.
Okay, cool. We can look at that. And now we have a few just
general. And I'm sure, like, I mean, you know, there's different levels of credit, right? I mean, there's poor, there's fair, there's good, there's very good. So you'd probably have to even segment out that you know, the default rates, you know, based on credit scores.
Mm-hmm. And we got a few questions, just kind of general concern about growth stocks and interest rates, inflation.
Like the one number, so one of the numbers that Paul, one of the founders of Upstart, has mentioned before is that 80% of Americans have never defaulted on a loan, but only 48% of Americans have what's considered prime credit. Mm-hmm. And then one of the things that he said, which kind of always stuck with me, is if you never default on a loan, then it means you paid too high of an interest rate. And if you do default on the loan, it means you paid too little as the interest rate. Like, if you think about it, it makes sense, right? I mean, if you take out a 5-year loan and you pay off the whole thing, then I don't know. I mean, it makes sense. And then it's kind of still silly at the same time, but for whatever reason, it's always stuck in my head.
All right, so we had a couple questions about growth stocks in general. Looks like there's a lot of anxiety out there about growth stocks.
There
So
is a record amount of bitchiness on my timeline, on stock twits, in my emails and DMs. So yeah, I mean, people are anxious, people are frustrated, people are
yeah,
stressed, depressed, definitely a lot of anxiety out there. And, like I say, the pendulum swings both, too far in both directions. So growth stocks were probably overvalued, overheated at the beginning of the year. And I would argue that right now, some, maybe most growth stocks are oversold, and we're going to need to find some equilibrium, right? I mean, the right value is somewhere in the middle. We just don't know when we get there.
so I think the most interesting question related to growth stocks is that of inflation. In an environment of really massive inflation that maybe we've never seen before in our generation, a lot of people are thinking there's going to be massive inflation that we've never witnessed, right, in America. If that happens, how does that, do you think, impact growth stocks?
So I guess I'm not in the camp of we're going to see, generational massive inflation like they saw in the 70s and 80s, where, I mean, interest rates were in the double digits. I just don't think we're going to get back to that. Part of the reason I just think, so we are living in an age of innovation and technology. And I believe that is very, very deflationary. Technology, what you can do now and how much more productive people can be. I mean, think about like, I don't know, the companies that are putting up record earnings, yet they are not hiring nearly as many people as you would have had to 10 or 20 years ago to grow at these sort of rates. And it's because of technology and software and AI. And I mean, think about what Upstart is doing. I mean, Upstart with their model is replacing employees at a bank. In the old days, you would have a bunch of people sitting around approving credit applications. And now Upstart with their software is doing that for the banks. So the banks can actually, I don't know if they want to fire people, but hire less people to, be in their underwriting departments. I mean, I would argue that that is deflationary.
Yeah,
So
and you're right. That's been deflationary. That's been happening, the last 20 years or so. But let's entertain for a second that you're wrong, and somehow there is big inflation.
right.
How would big inflation impact growth stocks?
So I mean, where do interest rates go? Where do short-term and long-term rates go? I mean, that's certainly what's going to probably drive the multiples on growth stocks. And I mean, I do think at some point, though, there has to be some separation between growth stock. I mean, right now it's like, I mean, like, yes, Upstart is a growth stock, but Upstart is a more mature, stronger fundamental company than even like DermTech, right? I mean, if you look at a price to sales multiple on DermTech right now, yeah, of course the stock looks expensive, but I'm looking out 2 or 3 years and what that company could potentially do with their smart patches, once they have all 3 of them out there in the market. And that's why I'm willing to get in early and pay a premium to own that stock before they get into that rapid growth phase. So, like, even when you take growth, I mean, you really have to split growth stocks up. I mean, then you have the really mature growth stocks like the Amazons and the Microsofts and the Facebooks that are still growing at, 25, 30, 35% with, I mean, Facebook, I think, has what, 40% net income margins. I mean, some ridiculous number. The amount of cash that they're generating every quarter is insane. And these buybacks. So I mean, there's like, to me, there's like 3 different tranches of growth stocks. There's and then like SPACs is kind of in their own little world. So maybe there's like 4 tranches. It's just, if we see rates going up, do they all get punished? Do they all, do the ones that are already profitable get punished? I mean, I would think so, because the ones that are profitable should have a little bit more less downside risk, I suppose. I don't know, man. I mean, does the 10-year get to 2% by the end of the year? I mean, I think there's definitely a chance of that happening. Does that mean there's another 15 or 20% downside in growth stocks? Maybe some of them. Hard to imagine that Upstart, with the guidance they've already given us, would have another 15 or 20% downside just because the 10-year treasury went from 1.6 to 1.8 or even 2. I don't know. I don't see how that it doesn't impact their business. I suppose it just impacts the models that drive these valuations, right? I mean, that's what it is, I think.
Yeah.
It's the DCF models that are using, risk-free rates of return using the 10-year treasury. And when you increase that number from 0.5 to 1.5, it changes the output.
Mm-hmm, mm-hmm. All right, Jonah, that's all I got from my end. Any other closing comments or anything else you want to touch on?
Oh man, these are rough days for growth investors. I think we all got a little too excited. I did. First 6-8 weeks of the year, it was just too easy making money in growth stocks. Probably should have I don't know, kind of taken a step back and appreciated it more while it was happening, and locked in some profits and bought some protection in our portfolios, put options, for instance. But, now we've pulled back 30, 40, 50, 60% in a lot of these growth stocks. And even the companies that are putting up strong numbers right now, strong earnings, you're not seeing great price action afterwards. So it just seems like, even good reports are getting sold, and then bad reports are getting absolutely destroyed. If you're in small caps right now, then so you have to worry about the price action after earnings. You have to worry about the short reports. You have to worry about the secondary offerings. I mean, like, there's a lot on our plates if you're investing in these types of stocks. But, I think that's where you have to take a step back and think about what kind of investor you are.
You just reminded me about, with the bad report getting killed, Intrusion Inc., INTZ.
Yep.
Are you still in that?
Yeah, I'm in it. Yep.
Okay.
So I did I got into that stock probably a month ago when it was in the high teens. Did a Substack write-up on it. I talked to investor relations yesterday. I have an interview with the CEO on Monday. The stock was down big today, which to me was, a huge overreaction to the earnings call yesterday. They were a little light on Q1 revenue, but for anyone that has actually followed the company or knows, actually, this is investor relations from Intrusion calling me right now.
Wow. That's funny.
What was I going to say? So Intrusion, just to give a quick backstory. So 30 years ago, when the company was founded, they were doing a lot of DoD consulting work and forensics work for cybersecurity. The founder of the company died a couple of years ago. They brought in a new CEO, Jack Blunt, who's been around the industry for many, many years. It's kind of a turnaround story right now. What he decided to do, he saw an opportunity to package up two of their main products. One is called TraceCop, and one is called Savant, and package them up into this new product called Shield, and sell that product to enterprises that want to better protect their network. So they announced that they landed a 3-year deal. I think it was a 3-year deal with Kimberly-Clark and a couple other large companies. They've reiterated multiple times that those contracts and some others amount to about 50,000 seats that have already been sold or licensed, but they haven't all been activated yet. As you can imagine, you don't roll out that many seats overnight to these large companies that have offices all around the world. So I think that was one of the reasons that people sold the stock today, was because, when the company said they had 50,000 seats sold, maybe some people were expecting to see all of that revenue recognized right away, and it just clearly isn't going to happen that way. They did say that they expect all 50,000 of those seats to be activated this year, but they think most likely within 6 months. He's talked very, very bullish about the pipeline of enterprise customers as well as government agencies, where he has the most relationships. They also have 35 resellers around the world, that are mostly going after the SMB business. They have resellers in Canada, Mexico, Australia, UK, Brazil, Lebanon. Kimberly, there was some doubt as to the legitimacy of the actual technology behind Shield. I've actually seen demos of it. I actually got a live demo with the head of the sales team, and I was impressed. I mean, I'm not a cybersecurity expert, but we did live demos, we timed it, we went to different websites. I could see the threats coming in. and then being killed off. So, and then also, I mean, Kimberly-Clark, right, Fortune 500 company, does not sign a multi-year contract and agree to have Shield essentially plugged into their network without doing a significant amount of their own due diligence and beta testing. So, the story, it's not a, let's just say it's not a very clear-cut story. I mean, there are some rough edges to it right now. It's definitely a turnaround. I mean, we're talking a small cap company that was run for DoD business for 30 years, and now they're trying to get into the enterprise space with this new product. I'm willing to be patient. I've said publicly that I'm going to give the company 2 to 3 quarters to show me that they can ramp up Shield. And if we get, another 2 or 3 large customers coming on board, then we can kind of get to the numbers that I think they're capable of. So there's 2 analysts that cover the stock. One had them doing 20 million this year in revenue. One had them doing 30 million. So consensus was technically 25 million. Given that Q1 was light, I think they're going to have a hard time getting to 25 million of like real recognized revenues for 2021. I think what they might be able to do is to get to 25 million of ARR by the end of 2021, which obviously sets them up for a really strong 2022. Just knowing how long it takes to close these enterprise deals and then how long it takes to activate all the seats that come with them, it doesn't happen very quickly. So I'm willing to be patient. I mean, I first got into the stock, like I said, around 18, maybe 19. Stock got down today to 10. So I increased my position by about 20%. So it's a 5% position in my portfolio right now with the cost basis just under 20. I've said that this is either an $8 stock by the end of the year or it's a $28 stock, because either they don't prove that Shield is viable and they don't land any more customers and they don't activate those seats, and then the stock continues to fall, or they do prove that they can close these customers. They bring on a couple more enterprise companies, maybe a couple government agencies. I know they're talking to some universities as well, and they start to activate these seats, and maybe they get to 100 or 150,000 activated seats by the end of the year. Then I think we're talking about a $28, $30 stock by the end of the year. So I'm frustrated and annoyed that the stock sold off. There was a short report that came out a couple of weeks ago, so that killed the stock by about 25-30%, and then it dropped another 30% after earnings last night. But I mean, there wasn't anything alarming on the earnings call. I mean, the only 2 red flags were, we're not giving 2021 guidance yet. But if you think about launching a new enterprise product into a market, it's kind of hard to guess, what revenues that might generate over the next 9 or 12 months when you don't have any track record to really fall back on. So I get why they wouldn't want to give guidance. And then 2 is, some people said that Jack has said, and I haven't heard him say this, so maybe this was private conversations, but they claim that Jack told them that they had 50,000 paid seats, but then on the earnings call, he says we have 50,000 seats licensed, but not activated. So, that's where some of the discrepancy is.
Yeah.
Like I said, I'm interviewing him Monday at 3:00 Eastern time. So I'll be able to ask some of these questions and maybe get some clarity on these things, because I'm curious as well. I mean, whether or not he's going to admit that he said paid before and not now, like, I'm not even sure I want to ask him that, because, that's kind of a tough position for him to be in. If he said paid, if he said they were all paid before, then that was obviously a mistake on his behalf. Whether or not he meant to mislead anybody, I obviously have no idea. It's possible that these companies are also paying an upfront fee. So maybe that's what he was referring to, is those 50,000 licensed seats are all attached to an upfront fee, but the actual seats themselves haven't been activated yet. So, who knows? Now we're just parsing words kind of, and, I don't know what he says behind closed doors to, other investors or analysts or whatnot. So.
All right. Well, Jonah, thank you so much for your time once again. Up on the screen, we have Can you see it? Is it the right screen showing?
Yeah, that's just my website.
Yeah, you got your website to subscribe to your Substack, and you can follow Jonah on Twitter at jonahlupton.com. And for story trading, you can check out our future events. Just go to storytrading.com events. We actually have a VIP session by Greg Fisher right after this, and a couple new picks coming up. And with that, I think we're good to go. And you
Okay.
can follow Story Trading on YouTube and Twitter. Thank you.
Later, guys.
We'll see you around, Jonah.
Bye.
Take care. Bye.